Well, welcome to class tonight. We're going to be talking about Chapter 2, and so let's get started. Here's the slide deck, and this chapter is about the investment process in general, and we'll begin with a investment policy statement. We're really looking for two things here. Mainly, we've got objectives and constraints. Part of the reason that we want to write all of these things down as well is that it gives us guideposts to go back to. If we just try to remember it, we're going to have our psychological biases. This is something we're going to discuss at greater length in I believe it's chapter 7. But if we write it down, it's easier for us to overcome some of those psychological biases. So writing this stuff down is terribly important, whether we do it on our own or whether we do it with the help of a financial advisor or a tax attorney or someone of that training. So let's start off with the objectives. Simple, right? Return is what we're after. Risk is what we're trying to minimize. Recognize that there are no free lunches. If somebody tells you there's a free lunch, they're probably lying to you. More than likely, you're going to get taken. So recognize that higher returns are going to be partnered with higher risk. Now, the question that you have to answer as an individual is, what sort of risk tolerance can you put up with? And many times you don't really know this until that downturn in the market occurs, and then you can't sleep at night, or you're calling your broker or your advisor immediately saying, what should I do? Should I sell? No, that's not the right time to figure it out. There are some surveys and questionnaires that can help to assess your risk tolerance, and there's some empirical evidence that they're fairly good at that sort of thing. So if you go to an advisor, they will have one of those questionnaires for you. You can even find these things online and try to assess how much risk you're able to tolerate. At least that gives you some sort of a proxy for what real risk you're willing to tolerate. All right, so that's the key with the objectives. When it comes to constraints, and by the way, I should, obviously another objective is, what are the things that we're trying to fund, all right? I mean, we've got short-term, medium-term, and long-term objectives. So on the short-term things, maybe you're a couple and you're trying to buy your first house. So you're looking for a down payment. $200,000 house, you want 20% down, you need to save 40K. So maybe you set a 5-year goal for that. Medium term, you might have a couple of young children who need some college education in 15, 16 years. So that's a medium term goal. Then you've got long-term goals like your own retirement, as well as many other possibilities. But those are the primary ones that most people are facing. So you set that out. That also gives you an idea of the horizon, which we're going to be talking about as one of the constraints. All right. So on to the constraints. Resources obviously are a constraint, right? How much can you put aside for the future? How much are you willing to put aside for the future? That's really more to the point. If you've got an undergraduate education in business in particular, your salary is probably sufficient to meet all of your basic needs. And then it's a question of, how much am I willing to defer versus how much do I want to spend right now? And those are important questions that you can only answer for yourself. As you'll remember when we talked about Chapter 1, there's a lot of volatility. And especially when you're talking long term, you put aside X dollars per month for 35 years, and that can grow either to something under $1 million, or it could grow to almost $3 million, depending upon the returns that you individually experience over that 35-year span. So keep that in mind as well. The best plan is to try to oversave. 10% is okay. 15% is better. 20 is going to put you in a really good position. Then you budget with the other 80%. And remember, too, that there are tax consequences to this. So sometimes when you're saving 20% of your gross salary, or even a take home, it can be in after-tax dollars, it can be less burdensome because you may be able to save those dollars pre-tax. Horizon, short-term versus medium versus long-term, matters. It matters mainly in what sort of investment you're going to put your money. So short-term, it's not a good thing to put it into very volatile investment classes or asset classes. Things like equities in particular, I'm thinking, right? 5-year horizon, I don't want that tied up in equities because the equities in 5 years could be down 50%. They could be up 50%. If I really want that down payment, I'm probably going to try to put that into CDs, money market mutual funds, maybe some short maturity bond funds, corporate, government, either one, maybe some combination thereof. Medium term, then I can put some exposure into the equities piece of it. But certainly with college education, sometimes there are state funded or state sponsored plans. So there are a variety of things to look for there. But medium term in general is, equities then become a part of it. Maybe not 100%. Longer term, especially if you're talking 30 plus years, a retirement type thing, you should be pretty fully funded in highly volatile securities so that you maximize that return. Get the most bang for your compounded return buck, if you will. Liquidity is a big deal, especially as it comes close to time to liquidate and actually achieve your objectives. And liquidity simply talks about how quickly can I sell an asset without taking a major price concession. Taxes, after tax, before tax. I've got a slide here a little bit later that talks about the difference between, or at least gives you some guidance on the difference between, say, a traditional IRA versus a Roth IRA. I've got some links for you to look at for the details. But the bottom line is it's after-tax return that matters, right? That's what we're after. And then are there any special circumstances in your case? Do you have a match from your company? If so, take every bit of it. If it's you put in 5, the company gives you 5, take it. That's like 100% return right there. Take it. Even if it's 10%, take it. That's 100% return right off the bat. There may be some sort of time limitations that you have to be in that plan or with the company for X number of years, but those are opportunities that you don't want to pass up. That's the best return for your money. Maybe you work for a company that requires or grants you stock options in the company stock. That's another special circumstance where your other portfolio, you don't want it in that company for sure. You've already got enough exposure. You don't want to be overly exposed to a single firm. And you may even be overly exposed to a particular sub-industry, industry, or even a sector. So you want to take that into account as you develop your portfolio for the rest of the investments that aren't constrained like that. Should you manage this yourself or should you go to an advisor? In most cases, the answer is the latter. Go to an advisor. Even if it's just a tax attorney, there are so many little wrinkles in the tax code. I can't keep up with it. I don't even try. Even with Social Security, there are strange little wrinkles that many of us are unaware of. There's a spousal benefit that is just huge that I was unaware of until a few years ago. Talking to one of our financial planning faculty members, and he said, hey, think about this. He was right. Same thing with the tax laws. So it's probably better to at least get some help. I would also recommend, you've got two choices when you go to a financial planner. It's fee-based or it's commission-based. Fee-based, the incentives are lined up to benefit you. The advisor, no matter what they say, if they're commission based, their company may be pushing them to have you invest in a particular type of asset or a particular security that the company gets the most profit from. And that's not what you want. It may not be good for you. So fee-based financial planners are the way to go. In terms of market timing, asset allocation, security selection, those sorts of things. Let's talk about market timing first. Market timing is a fool's game. I've tried it. Everybody needs to try it. Put a small piece of money aside. See if you can do it. You might think you can for a while until you can't, and then you miss it. You can miss it on the upside. You can miss it on the downside. I've had both happen. I've played that game. I also know that theoretically and empirically, you can't time the market. It's a random walk. That means it's random. We can't predict when it's going to turn. So market timing, not a good plan at all. Like I said, if you want to play around with a little small fraction of your portfolio, just to keep your interest up and see how you can do, okay, fine. But don't put your entire portfolio in there. Don't put the stuff that's going to make you either live well in retirement or not so well. Don't do that. Asset allocation is really where it's all at. Whether you're putting your money into stocks or equities, whether you're putting your money into fixed income or bonds, same thing. They're synonyms, right? Bonds, fixed income, corporate government bonds, currency, commodities, things of that nature, real estate. Those are the asset allocation decisions. So when I have a very long horizon, for example, I'm going to put more of my money into the more volatile, higher return securities, like equities. As my horizon shrinks, as I approach my date, then I'm going to shift that into lower volatility securities like bonds. So that sort of decision is going to give you 90% of your return. I'll show you on the next slide. Actually, all the empirical evidence tells us that. Security selection, again, not unlike market timing, something of a gamble. Again, the empirical evidence really drives home the point that the markets are efficient. It's unlikely that you're going to find that security that is mispriced, whether it's under or overpriced. It's unlikely you're going to find it. We've got to keep trying. And obviously, depending upon who you are and what sort of work you're doing, if you're an analyst, a security analyst, maybe you do find those. Maybe you can build up a track record in that. But if you're just the average investor, security selection is probably not worth it. Firms that engage in active investment management typically have very high fees. And again, the empirical evidence suggests that most of those investments, after you factor out the fees, are not beating the market. So there you go. And here's the slide that shows that the empirical research suggests that 90% of your portfolio's performance comes from asset allocation decisions. Am I 70% equities and 30% bonds, or am I 60% equities, 30% bonds, 10% cash, or money market type of things? So that's where it's really at. As an example, during the crash of 2008, bonds outperformed stocks in 2008. And those asset classes keep changing over time. There's always one that has the highest performance. It could be real estate. It could be tech sector. It could be fixed income. It could be commodities, a variety of different asset classes. But again, you can't predict that ahead of time. So you want to spread your money across all of the asset classes with the idea that you're going to focus on those riskier asset classes. If your investment horizon is longer, you're going to focus more toward the lower risk asset classes when your horizon gets shorter. This is a relatively recent study by Hank Bessenbinder, one of my colleagues and a friend of mine that I know back from my days at Arizona. This study has gotten a great deal of attention in the professional world as well as the academic research world. What Hank did was he looked back to 1926 and he tried to figure out which stocks actually created a positive return. He found that after accounting for dividends, including dividends, that only 4% of the stocks gave us all of the return that we've had in the market from 1926 to, I forget the date of his, the end date of his study. I think it was probably 2018, 2017. 4% of the stocks, less than 1 out of 20 stocks actually had a positive return. The other 19 stocks didn't do even as well as putting your money in a money market mutual fund. And in fact, even more to the point, the 5 stocks listed here, Exxon, Apple, and Microsoft, GM, and IBM, these 5 stocks, just 5 stocks accounted for an entire 10% of the total gain in the market over that span of time. It's an incredible finding. All right? You might ask the question, well, how did GM get in here? Because they're not doing so well. And the answer is they paid a heck of a lot of dividends. And the way Hank looked at this is he reinvested those dividends. So once you account for the dividend reinvestment, GM is a fantastic investment over that span of time and largely contributed to the gain in the market over that same period of time. Now, the professional investment industry looks at this study and each side of it. So you've got the active managers, you've got the passive managers. Each side really finds something in this study that supports their bias, right? So the active managers go, hey, I can pick those 4% of stocks. I can pick those for you. And you put all of your money in that, and your return will be even higher, right? Because you don't have to have the dogs, the 19 out of 20 that don't perform. I'll get you that 1 out of 20 that performs. The passive managers, on the other hand, say, that's impossible. There's no way that you could possibly know that. The best strategy, according to this study, is to put your money in the market as a whole and let the market get that market return. You know you're going to have those 4% of stocks that actually perform. Yeah, you've got the other 96% that don't, but at least you get the market return. So real interesting study. I've got a couple of links here that you can use and read these articles. They're relatively short, directed towards a practitioner type level, so it's nothing technical in particular. But check this out. It's a really cool study. Here we're talking a little bit about the part I mentioned earlier about what sort of after-tax performance you want. And for instance, a good example of this is that IRAs, individual retirement accounts, right? They started off with what's now known as the traditional IRA. This is all a function of the IRS tax code, right? And basically what it said was that if you put your money into this, you can do it with pre-tax dollars. In other words, you're not taxed on that income until you take it out. And then you pay taxes not only on the money you put in, but the gains that you made on the other side. Then, a few years later, some period of time later, legislators came up with another type of IRA, and they called that the Roth IRA after one of the senators who sponsored that bill. And that says, hey, we're going to have you put in after-tax dollars, but when you take out your money, including the gains, you don't get taxed on any of it. Now the question becomes, well, am I having a higher tax rate now than I will have in retirement, or vice versa? Is the government going to change these rates? A lot of uncertainty. How do I decide? Do I want traditional? Do I want Roth? Well, in comes Brown, Cedarberg, and O'Doherty all of whom, pardon me, are professors at University of Arizona. They did a little study, tried to figure this out. I've got the link here to their paper that's also in the Canvas under modules, under resources for today's lecture. But if you want the details, do read the paper, or at least read the intro. Let me give you the short version. Put half your money in each. That's the short version of it, because you can't predict what the tax rates are going to be, and you basically covered all your bases. Another thing to decide when you're talking about an investment policy statement is, what kind of brokerage service am I going to use? Am I going to use a full service broker? Am I going to use a discount? Or do I use a deep discount online brokerage house? Many of us have migrated towards the latter because we don't necessarily want the services of a full service broker. And you probably don't need that, especially if you have a financial planner that's a fee-based financial planner. So that decision is relatively easy. I do want to draw your attention to a little comparison I did, though. I know that many of you are probably in Robinhood, or may have a Robinhood account. It's fairly popular. It's lost a little bit of luster lately because of some of the things they've done recently, in particular related to some of the like a GameStop type of strategies and so forth. But I wanted to look at Robinhood and say, well, what do I gain out of having Robinhood versus a more traditional online deep discount brokerage house like E-Trade? I'm not promoting either one, but I just did this comparison to take a look at the two. When we're looking, sorry about that. When we're looking at minimum deposit, they're the same. Stock trades, the commissions are the same, 0. Mutual funds. Robinhood doesn't have any mutual funds that you can trade on their platform, whereas E-Trade does. So do the other more traditional online brokerages. Annual fee for an IRA, $0 in both cases, so they're comparable. Fractional shares. E-Trade, you can trade in fractional shares. Let me ask you, what's the benefit of trading in a fractional share? There's only one stock that I would even consider trading in fractional shares, and that's Berkshire Hathaway. It's nearly $500,000 per share if you buy Class A stock. You can buy the Class B, though, for a few thousand. So what's the point of fractional shares? If I have so little money that I can only put $100 into it, I'm probably, yeah, okay, go ahead, use Robinhood, but that's not really where we're at. We're talking about portfolios that should have several thousand, if not tens of thousands of dollars in them, especially even early on, right? Because you're going to be putting away at least 15%, better yet 20% of your income. So fractional share trading, who cares, frankly? Crypto trading, again, a difference between the two. E-Trade doesn't have crypto. Well, so what? Crypto is basically the next Ponzi scheme. It's not really a Ponzi scheme per se, but in some sense, basically there is no there with crypto. And we'll talk about this more later on, but there's really nothing to value. So I can't value crypto. I'll talk about actually a exemption or something that I could value, but I'm here to tell you that the central bankers are about to take that off the table too. Not by regulation, simply by replacing it with a better system. So one thing that crypto has done is it's motivated central bankers to become more efficient. Okay, great. But crypto as a asset class, it's a very bad investment. And again, we can talk where we have an interactive session more about this. If you've got differing opinions, I'm open to hearing that, and we can have a little bit of a debate on it. But for the moment, let's just assume that doesn't matter. So basically we said, okay, this difference doesn't matter, this difference doesn't matter. We'd actually prefer to be able to put some of our money in mutual funds. How about no-load funds? Well, E-Trade has over 6,500 no-load funds that you can trade on their platform. Robinhood has none. How about bonds? E-Trade's there too. Robinhood, no. How about if you want a more full service type of service? You can get that if you want to, for additional fees, of course. But it's there. Robinhood, none. So while I understand that Robinhood has ticked a lot of boxes for 20-somethings, it's probably at your point in your profession, it's probably time to start thinking about a more broadly based online trading platform. SIPC, just a quick pointer on this one. Yeah, it's a lot like the FDIC in banks. It's a lot like the NCUA when it comes to credit unions. What they're doing is they're protecting you from bankruptcy of the brokerage house. And I emphasize that because it's not protecting you against the total loss of your investment because the stocks in your investment went to zero. They'll still go to zero in the SIPC. You go talk to them and they'll go, well, hey, you took a risk. Tough luck. What the SIPC protects you from is if the brokerage house goes bankrupt. And here's why it matters. Because most of the time, especially when you have an online account, you're trading stocks that aren't in your name. They're in the brokerage house's name. That's how you can trade them in a matter of a few seconds online, because they don't have to transfer it out of your name into their name and then trade it. It's already in their name. So if they go bankrupt, the stocks are in their name, those could disappear. So the SIPC comes in and says, well, whatever the value of those were, we'll replace those for you on the day of the bankruptcy. So that's what the SIPC protects you from. It doesn't protect you from the riskiness of the underlying investments in your portfolio. It just protects you from the riskiness that your brokerage house actually goes belly up. Just a couple of things to point out here. Of course, the advice from your advisor, no matter who they are, fee-based or commission-based, is not guaranteed. They don't have a crystal ball. They may be more informed, more knowledgeable, but yeah, even their predictions can go wrong. Even their plans can go wrong, and you may not be able to entirely meet your goals, and you'll have to make adjustments along the way. As long as you're working with them on a regular basis, though, usually that can be mitigated by increasing your contribution or putting it into a riskier asset class to bump up your return, that sort of thing. Okay, now we get into kind of a more technical piece of the chapter, and this is talking about using borrowed money to invest in stocks. And we have two types of investments. We can go long. In other words, that means buying a stock, right? Long is buying, short is selling. And in fact, a short margin position means that we can actually sell a stock that we don't even own, which is kind of a weird concept. We're going to start with the long margin position. That is where we buy a stock with some of our money and some money that we borrowed. So we're leveraging our investment. All right. So let's start with that. Oh, sorry. My bad. First, the cash account is simply cash, right? I put in $10,000. I use that $10,000 to buy stock, whatever the stock is worth, minus what I put in, the original 10 I put into it. That's my return. All right. Easy peasy, minus commissions and so forth. Now, when we talk about a margin position, a long margin position, that's where I'm buying stock. That's what the long part means. The margin part means I'm borrowing some of the money that I used to buy that stock. So let's take a look at this example. We've got 100 shares of Walgreens Boots Alliance, WBA, and it's currently selling for $80 per share. We only have $5,000, And we'd like to buy more or as much as we possibly can with that $5,000. So we go to our broker, and our broker says, well, you know what? We'll allow you to borrow up to $3,000 in addition to that five that you already have. So you have a total of $8,000 to invest in WBA. This gives you what is called a margin of 62.5%. Margin is something that we should talk about here. Margin is what I own. Oops, went off the edge here. What I own over value of the position, or in this case, stock. Okay, and it's stated in percentage terms. So let's go back to the slide deck. So in this case, what I own, or another way to put that is I could call that net worth, right? That's the asset minus the liability is my equity or my net worth or what I own. Okay? So that's the 5,000. I borrow 3,000, so I put the entire 8,000 into the stock. So I buy 100 shares of WBA. That value of that stock at the time I open the position, is $8,000. That gives me a 62.5% margin. In other words, 62.5% of the investment in the stock is my own. It's my net worth. All right. If we look at this in T account terms, and let me just move over here out of the way. It's not entirely out of the way, but here, we'll get completely out of the way. And so let's look at this. We've got a T account here. Left-hand side is our assets. Right-hand side is liabilities and equity. On the left-hand side, this is very, very important. I can't emphasize this enough. The left-hand side, the assets are stated in shares. We can restate that in dollar terms at any point in time simply by taking the number of shares of the asset times the current share price. So in this case, when we open the position, we've got 100 shares, and the share price is $80 per share. So that's $8,000 of asset value. The margin is over here, and that's the liability, and that's stated in dollar terms. That's a constant, okay? The assets, the dollar value of the asset is going to be variable. So that can go up and down in dollar value. The number of shares stays the same, but the dollar value can go up and down. The liability, though, is always going to be $3,000. That's what I pay back. The difference between assets and liability, of course, is our equity stake or our net worth, if you will. And of course, the sum of liabilities and equities has to equal the asset value of $8,000. All right? And these T accounts are a great way of tracking this and keeping track of what you're investing. All right, so let me come back up here. In fact, I'd get over here. All right, so let me illustrate this in a more graphical fashion here. A long position. We open the position by hopefully buying low, and that is today. And then we close out the position in the future at some point, hopefully at a higher price. The difference, obviously, is our dollar gain. All right, so let's look at a couple of terms here related to margin accounts. This is going to be the same in whether it's a long margin position or a short position. We're going to have some sort of minimum margin. And there are two types of minimum margins. One of them is the initial margin. That is the minimum amount of dollars as a percent of the total investment that I have to put up myself. According to the SEC, that minimum has to be at least 50%. It used to be, prior to the Great Depression, that you could borrow up to 90% of the money. In other words, you would have a initial margin as low as 10%. And a lot of the research suggests that that is what led to the crash of 29, is that there was too much leverage in those positions. Small changes in value wiped out the equity stake, and it wiped out the net worth of the individuals, and led to the continuing decline in the share prices as stock was being liquidated to meet margin calls. So that's been changed. It's been, or excuse me, did I say SEC? That is Federal Reserve, actually. So that 50% has been in place for decades. All right. Then there's this thing called maintenance margin. The maintenance margin is the minimum margin that must be present at all times. So you open with the initial margin of 50% or higher. In this example, our initial margin back here on this slide right here, our initial margin was 62.5%, right? All right. Now, let's say that we opened at 50 instead, and it's a long position. We make a gain when the stock price goes up. We incur a loss when the stock price goes down. So our margin goes up when the stock price goes up. Our margin goes down when the stock price goes down. So let's say, for example, that the stock price went down. We opened at 50%, and the next day the stock went down in price. So our margin drops from 50 down to maybe 45. And then the day after that, it drops again, and our margin drops to 40%. Well, there's a maintenance margin. And let's say in this example I'm giving you, let's say the maintenance margin is 35%. As long as my actual margin is above the maintenance margin, I don't have to do anything. I can still close out the position if I think it's a losing proposition in the long run. But if I think I want to hold on to it and that eventually it's going to continue back upward, then I don't have to do anything. If it hits 35% or goes below 35%, that's going to trigger what's called a margin call. The broker is literally going to get on the phone, call me up, and say, Bill, if you want to keep this position open, I'm going to need some more cash from you. If you don't give me the cash and you don't give me any other instructions, I'm going to close out the position today. And I'll get whatever is left over after they close out the position. If I choose to inject more cash, I have to bring my margin up to what my original initial margin was. In my example here, 50%. So let's say it drops down to 35. Now I've got to get a big chunk of cash to bring it back up to 50%. And then the position stays open, and I keep hoping that the stock price is going to go up eventually. Here's another example. Suppose we have an initial margin of 50% in this case. We have a maintenance margin of 30%. This reference is probably missed by many of you. Only if you were watching old episodes of Seinfeld will you get the Vandelay thing, but it was a company George worked for. Anyway, so the ticker is Vane. It's currently selling for $50. You have $20,000 in your own money, equity, net worth, whatever you want to call it, cash. And you would like to take full advantage of the money you can borrow from the broker. So with an initial margin of 50%, that means you can borrow an additional $20,000. So you have a total of $40,000 to invest in Vane. All right, at the price of $50 per share, that means you can buy 800 shares of Vane. All right, so here's our T account again. Assets over here. Remember, this is stated in shares. Currently at $50 per share, that gives us an asset dollar value of $40,000. Over here on the liabilities and equity side, we have the loan of 20, and we have our own cash that we put into this of 20, again for a total of 40. That matches up with the equity side. All is good. Now, let's assume that after that purchase, the price drops to 35. So our equity falls by $15 per share times 800 shares, a loss of $12,000. And remember, that's all on us. We still owe the $20,000 to the broker. They're not going to reduce that. They're not sharing in the gains, so they're not going to share in the losses, right? So let me go back over to the right side. Let's look at the assets first. Again, notice the shares stay the same. The dollar value of the shares at 35 changes from 40 down to 28. That's a recognition of that $12,000 reduction in value. And of course, that leaves us with 28,000 total on the asset side. Now I need to look at my liabilities and equities. I still owe the broker 20 grand. So 28 minus 20 leaves me with an equity stake of 8,000. And again, my balance sheet balances, so the world is good. Now, let's take a look and figure out, are we going to get that margin call? Remember, the maintenance margin was 30%, initial margin of 50%. Okay, net worth, 8,000. I got that right down here, right? Value of the stock, well, I pull that right off of my asset side. So 8,000 divided by 28,000 is 28.6% margin. I'm below my maintenance margin. I can expect a call from my broker. And the broker is going to demand that I inject enough money in order to bring my, not up to 30, my margin, but up to 50. Why not up to 30? Well, if I only brought it up to 30 and the price kept going down, I'd get a margin call tomorrow. The broker doesn't want to be on the phone with me every day. So I've got to bring it up to leave myself some room, if you will, for continued price decline. All right? So I've got to bring it up to 50%. How much money do I have to come up with to do that? Well, it's pretty easy to calculate. What would a 50% margin look like with a asset value of 28K? Well, I would need $14,000 in there. I have $8,000, so I need to add an additional $6,000. I need to send that to my broker today. Okay? And what that will do, the way that'll look in my T account, is I still have the 20,000 here. I still have the 800 shares, which are worth 28,000. Now that means I've got that 8,000 in equity. There's my liability, there's my equity. Now I'm going to send my broker an additional $6,000. That's also equity. Get 6,000 over here. And that brings me up to what, 34? And got 34 on this side. And then I go on and again hope that the price moves up. If it doesn't, I can close out and I get whatever is left over and pay off the brokerage loan. All right. In this particular example, we have $30,000 in a margin account. We have a 60% initial margin. So that means we can buy $50,000 worth of stock. Well, why is that? Well, with a 60% margin, and we have, what is it, 30,000? We're solving for that denominator. There's our 50,000. Your borrowing rate is 6%. Suppose that you buy 1,000 shares of Verizon for $50 per share. Assume no dividends and that your borrowing rate is still 6%. What is your return if the selling price is 60 and in 1 year the selling price is 60 per share, but you did not borrow money from your broker? In other words, you just used your cash. I'm going to stop at this point and mention to you that in this chapter, there is a problem with the way the interest is calculated for the long margin position. It's incorrect, and I've talked to the authors about it. They're in the process of dealing with that. But what we're going to do for our purposes, we're going to pretend there is no interest on the margin accounts. There always is interest on the margin accounts owed, but because this chapter kind of creates a backwards process, it's the exact opposite of what we would actually do. And I don't know how this happened in the chapter. This is one of the weaknesses of this book. Hopefully they will fix it in the next edition. But that interest calculation is incorrect. So rather than confuse you even further, what I'm going to say is let's just not worry about the interest on margin loans. All of the problems we're going to solve will not have any interest calculated in them. I've removed those problems from the homework because it's difficult to figure it out. It works using their process, but that process is the opposite of what should be done. I'll leave it at that. For you all, it just means that you don't have to calculate interest in this case. All right? And if you have any further questions about that, I'd be happy to explain it in more detail. But for this recorded lecture, I'm just going to leave it at that. So we're going to ignore this problem and that problem. Now, one thing that we will pick up on is calculating a price at which you will get the margin call in a long margin position. All right. So how do I do that? Well, there are two different ways you can actually do that. One, there's a formula. You just plug and chug. Price is on the left-hand side, and you work through the math on the right-hand side, and boom, out pops a price. The other way I think is more intuitive, but I leave it to you as to which way you want to choose to go. I'll show you both. All right, so in this example, we have 300 shares of Coca-Cola at $55 per share. So the total cost is $16,500. We only have $9,900. So we borrow $6,600, making our initial margin $9,900 over $16,500, or 60%. Now, also suppose that our maintenance margin for this investment is 40%. By the way, maintenance margins can vary by a lot. The way the maintenance margin is set is that the broker determines what it is. So each broker might have a different maintenance margin for a particular stock. But the idea here is that what the broker is trying to do is to minimize or reduce to zero the probability that they are left on the hook owing some money after all of your equity is used, right? So if the price goes down, you get a margin call. You've got a day or so to meet that margin call. What if the price continues to go downward and it actually exhausts more of your position than you have equity? That means if you don't put up the money and just walk away, the broker's on the hook. So the broker wants to make sure that you are going to have skin in the game no matter how fast that price falls. So they're going to set this maintenance margin at a higher level for more volatile stocks and at a lower level for less volatile stocks. So in this case, it's kind of in the middle, 40%. But what we would like to know as an investor, we'd like to know in advance. We've opened up this position at 55. We're hoping that it goes up. That's our expectation. That's why we're buying it. and we're using leverage to magnify our returns. But we'd also like to know, well, how low will it go before I need to come up with some additional cash to keep the position open so that eventually when it goes up, I can take advantage of those additional returns. So here is a formula for that. And right here, in fact, let me just move over to the right. This is the formula. So how much did we borrow? In this case, 6,600. How many shares are in the position? 300, all right? And then 1 minus the maintenance margin in decimal terms. Do the math. We come up with a price of 36.67. That's the easy way. Not a lot of intuition there, but plug and chug, boom, you get an answer. Up here, this is the formula for margin. It's actually where this formula came from. But notice, over here we have the number of shares, right, times the price. That's the value of the position minus the amount borrowed. So that's, if we look at our T account, okay, so we had, let's go back here, we had 300 shares times whatever the price is. That's the dollar value of our assets. And then what did we borrow? In this case, that was $6,600. Okay? And what is assets minus liabilities? Simple. It's equity. Right? So that numerator is my net worth, or my equity stake. The denominator is simply number of shares, again, 300, times the current price, P. That's the value of the position, or the value of the stock. Oops. Okay? Now, all I have to do is solve that. So I can plug in, let me clear this off. Oops, sorry. So what I can do is I can start plugging in my numbers. My margin is 0.4 or 40%. And then I have in the numerator 300p minus 6,600 all over 300p, right? Oops, here I am in the way again. All right, so now I've got one variable, one equation. I just isolate p over on the left-hand side. The only challenge is that I've got p in two places, and I can simplify that very easily, actually, by recognizing that 300p over 300p minus 6,600 over 300p, I recognize that that is 1. So it's simply 1 minus 6,600 over 300p is equal to 0.4. A little bit of rearranging. I isolate p over on the left-hand side, and I solve the rest of that, and I should end up with exactly the same thing, 36.67. So depending on your comfort with dealing with this algebra, you could use this way of getting to the price at which you'll get a margin call, or you can just do the plug and chug into this formula. One warning with using this formula, though, and that is when you're calculating the price to a call for a long margin position, this is the correct formula. When you're calculating the call, the price at which you'll get a margin call for a short position, it's a different formula. Those will both be on the formula sheet, but make sure you know which one to use. If you use this method, You don't need a formula sheet. You don't need to remember anything other than margin is equal to net worth over value of the stock, and plug things in, and it's going to work whether it's a long position or a short position. Again, depending on your algebra, comfort with algebra and manipulating these numbers around, you pick one direction, whatever works for you. We also want to annualize returns, just like we did in Chapter 1. So if we have a particular return over a 3-month period, there are 4 periods, so we raise that return 1 plus that return to the 4th power, subtract off the 1. We have an annualized return. I think you've got that drill already. So here's an example. I'm not going to belabor it, though. And here's another example of getting that annual return. I'll let you go back and visit those slides. And I think this is a good spot to stop. So we will pick back up on this in the live lecture, but I wanted to get this onto YouTube for you. And so I will see you for the rest of this chapter in the live session. Thank you.